Welcome to SB Talks. Today is Tuesday, December 2nd, and I am joined for our penultimate podcast of the year by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing US PMI data and cracks in their growth picture, Australian inflation and the crush to the rate cut hopes, as well as markets taking a moderate breather in November. Welcome to all our listeners. In a year dominated by tariffs, dare I say, so much so that we almost renamed this the Tariff Pod at one stage, are we starting to see signs that they're now beginning to bite on the US economy?
Yeah, there's some tentative signs in the latest PMI or Purchasing Manager indices that have come out of the US. So the US ISM PMI, which came out recently, showed a slump from 48.7 to 48.2 for November. Anything below 50 is a sign of contraction. Yep. So that's further contraction in the manufacturing sector. Even though that's only about 10% of the US economy, it is the most sort of cyclical part and probably the part that's most affected by tariffs. So,
and that's a material move as well.
Yeah. So there was if we look at the detail, input prices for the manufacturing had increased, orders were slumping, and employment had also declined. So it sort of paints a stagflationary picture where tariff uncertainty and higher input prices are having an impact on orders and activity in that sector. Only 4 industries reported any growth. One area that was particularly affected was sort of transport. They're obviously been subject to 25% tariffs on car parts and things like that. And they did talk about layoffs and redundancies in that sector and blamed them on Trump's tariffs.
Even though he was trying to save the auto industry, one of his bastions that he's trying to protect in all of this. But it's such a complex production line and complex supply chain of parts for auto industry, very hard to manage around tariffs.
Yeah, definitely. So, and also the uncertainty. I think it just takes so long to reorient your supply lines. So that's definitely a part of the economy that is really starting to feel the pinch from tariffs.
And we have this very much dual speed US economy. So we have, let's say, AI expenditure exploding, and that intention of spend is sort of accelerating as we near the end of the year.
Yeah, in the PMI survey, the one area that was sort of strong was computer and electronic products and machinery. So sort of tying into that data center theme. One sector that is doing well. Yeah. And the same, it's not just in the US. In Europe, the manufacturing PMI in Germany was weak. That slumped from 48.4 to 48.2. In China, their PMI's down, their manufacturing PMI from 50.6 for the rating dog one to 49.9, or their National Bureau of Statistics 49 to 49.2. So a bit better, but still both of those below
sub 50.
Below 50. So those, China obviously did well at the start of the year with sort of tariff front loading, but now that's sort of unwind, and so Germany, China, the big manufacturing economies also feeling a bit of a.
So worth recapping what that front loading is. When producers are worried about the tariffs that are to come, they're buying a lot of supplies, or they're buying extra supplies in advance, which saw this sort of surge of imports trying to get in front of the tariffs. But that supply now, we'd assume, is being depleted, if not completely depleted. So we're having to potentially go back and buy more, but more cautious in that buying activity just because of not just the tariffs, but the uncertainty, the continued moving picture on them.
Yeah, that's right. There was a lot of front loading in the first 6 months of 2025, but that really seems to have run out of steam. And so we're now seeing the impact of the tariffs actually coming through, impacting orders and activity in global manufacturing and trade.
Now, locally, big story in the last couple of months has been where the RBA, what direction the RBA was heading, and a hope, and certainly a political hope, that there'd be at least one more rate cut pre-Christmas. Inflation has absolutely crushed that party now, and if anything, it's tilted many economists to sort of be erring on the side of the next move might be up.
Yep. So the last week we got the first official monthly CPI number for Australia.
So maybe just explain that one if you can, and sort of this transition from the quarterly to the monthly.
Yeah, so we've had, up until this point, we've had a quarterly CPI. For the last couple of years, they've been trialling this, what they call the monthly inflation indicator. That didn't measure everything that the quarterly CPI measured. But now, from October, the October CPI does measure everything in the CPI basket. So that going forward, we will now be the last of the G20 countries to have a monthly CPI. So that's a good thing. There is a period where they will run the quarterly one and the monthly one sort of in parallel for about 18 months, just to smooth out some of the noise that we might get in the monthly CPI. And there's still some issues around seasonal adjustments. So, at different times of the year, travel and fresh fruit prices might go up. So they try and smooth that out with seasonal adjustments.
Yeah, and as everybody gets comfortable and confident in those monthly numbers as well.
Yeah, so we got the first October one, and it was pretty ugly.
It was a shocker.
So the headline inflation number went from 3.6 to 3.8. Now, some of that is due to electricity prices subsidies finishing. So that was a little bit expected, but it was still higher than what the market had been forecasting. And the trimmed mean, which is the RBA's preferred measure of underlying inflation, rose from 3.2 to 3.3. So a fair way away from their 2.5% midpoint of their target band. So heading in the wrong direction. And definitely getting the market to reassess chances of another rate cut. So 2 of the big 4 banks now have no further rate cuts, and the market even has 14 basis points priced by this time next year of rate hikes. So that's about slightly more than a 50% chance of a rate hike in the next 12 months.
125 bips hike in the next 12 months.
I think we'll... we'll get the Q3 GDP numbers tomorrow, and there's also some expectation that could be quite a strong number. We've had a few of the partial indicators, including capital expenditure, which I'll touch on in a second, but it shows that maybe growth in the third quarter was 0.5, 0.6 or 0.7%, which if you add to the 0.6% prior, that means the economy sort of averaging around 2.5% growth in the second half of this year, which is probably above trend. And particularly given the economy is sort of running into capacity constraints, unemployment's low, a lot of businesses are saying that they don't have a lot of spare capacity. That just suggests that there could be some more sort of inflation pressures if the economy is growing a bit too strongly.
And you've talked about here before on the pod that we've had, I guess, the lagged effect of the prior cuts and a bit of that flowing through into the economy now and seeing some of that resurgence, and I guess positive from an economic perspective, but it seems to come with a fair inflation baggage with it.
Yeah, well, that's right.
Given those combined factors, there's really little to no onus on the Reserve Bank to make a move.
And it gets back to that thing we've spoken about before, which is the lack of productivity improvements. So if you have an economy that's growing strongly but productivity is increasing, then that's not creating inflation. If productivity is flat and the economy is growing strongly, that can potentially be inflationary.
Yeah, and productivity, every projection that's baked into the RBA's numbers or Treasury's numbers, productivity continues to be way beneath that mark.
Yeah. I might just go back to the CapEx numbers that came out last week. So we get these what's called GDP partials. So we get the investment numbers. One of the components going into GDP is sort of investment. And we got 6.4% quarterly growth in investment in the economy. The bit that goes into GDP, plant and equipment and machinery, that grew 11.5%. It was the strongest ever recorded quarterly growth. And if you dig into the details around that, it was data centers.
Of course.
So equipment going into data centers, not the actual buildings, because that doesn't get measured for GDP purposes, but the actual plant and equipment, i.e. the servers and things like that, that grew 92% just in the third quarter.
So 92% quarter-on-quarter.
Quarter-on-quarter growth.
Yeah.
So just another
staggering
sign that not just is the US sort of benefiting from investment in AI and data centers, it's actually happening in Australia as well.
Yeah, and again, that sort of leading the charge out on its own, the sort of the data center and the expenditure that's happening there, sort of almost slightly out of step with the reality of the rest of the economy, but it doesn't seem to be slowing down in any way, shape or form.
That's right.
Picking up speed.
Now there is an offset because a lot of that equipment has to be imported, so that actually is a detractor from GDP. So we just need to see how it sort of comes out in the wash.
Yeah, unfortunately, we're certainly not producing that equipment domestically. Getting a feel for who may be the anointed one for the next Fed chair, dare I say, the poison chalice?
Yeah, well, Trump sort of indicated that he's made a decision. There's been about 4 or 5 candidates that have had their names thrown around. Polymarket, which is the prediction market that people can bet on, has Kevin Hassett as the 71% chance of being the next Fed chair.
What do we know about Kevin?
So Kevin is he's an American economist. He's currently the director of the National Economic Council, which is part of the White House administration, the U.S. administration. Yeah. He's sort of previously been an advisor to sort of Republican presidential candidates, and also he served in Trump's first term as an economic advisor. So he's definitely in the Trump camp. We know Trump wants someone that's, his man, and who has indicated that they're, prefer lower interest rates than higher interest rates.
Malleable to his perspective on the world.
So yeah, Kevin Hassett definitely ticks the boxes there. He has he worked in the Fed as an economist in the mid-90s, so he knows the Fed. He wasn't on the board, but he was an economist that worked there. So he seems like he's
not without qualification. Of course, the fear is here if we start to see a breakdown in some of that independence and monetary policy is getting too loose at a time where inflation's creeping up, then you could create quite a problem.
That's right. But we know, I think there's still a high degree of confidence that there's enough sort of independently minded people on the Fed that even though he's the chair, doesn't necessarily mean his view will carry the day. And we are actually seeing a bit of a split in the current Fed, so we have New York Fed, John Williams, he's a deputy chair, talking about, seeing the need for a December rate cut. So that's really swung market pricing around in the last few weeks because we had, Chair Powell sort of saying December's not a done deal. But now we've had, some other speakers sort of leaning on the side of a rate cut in December.
I'm wanting to get out on the record on that.
So that's now 23 basis points priced, so 90% chance of a cut this month. Yeah.
Now, it's been a very risk-on year post-Liberation Day, but we have seen a little bit of venting of the heat out of few markets, like certainly the equity markets and even, dare I say, the crypto market, which is one of the bellwethers of where the sentiment is at. What are some of the factors driving that?
I think it's just there's been the unwind of the momentum-driven rally. So, I think we mentioned before, meme stocks, anything AI-related, crypto and even gold, it's sort of gone up in a sort of uninterrupted straight line from the April lows. And that's just sort of run out of steam.
Probably a welcome check in some of that momentum on quite a few fronts.
Yeah, I don't think there's one catalyst that you can necessarily pin it down to. Maybe a bit of this chatter around AI bubble and people wanting to take some profits. But yeah, there's definitely been a big unwind there. And so, crypto, Bitcoin's was off for 8% last night and Ether down 10%. As some of there's speculation that a lot of people have borrowed money, sort of leveraged bets on some of these things were having unwind or getting margin called. So that's, I guess, could be part of it.
Not that we necessarily look at those as core investment markets, but they are an interesting bellwethers where sentiment is in terms of risk on and risk off.
Absolutely. So sentiment was, coming into November very, very high, and now in our measures, it's sort of more in that sort of, swing between. That was sort of what we call the greed zone, and now we're more in sort of fear zone. Not quite fear, but it's recovered a little bit in the last week or so.
Yeah.
But
probably a bit of a pressure release.
Yeah, a bit of probably a healthy thing, just to remind people that markets don't go up in a straight line.
Yeah. And we've even seen a little bit closer to home, the banks, which had been enjoying sort of in CBA in particular a stellar time, have also sort of had a little bit of a breather.
Yeah. Once again, that was a stock that was, overbought, probably.
Trading on tech multiples with
tech-like multiples. They delivered a quarterly update last month, which wasn't too bad. I think one couple of things that got the market's focus was a slight decline in their net interest margin. Nothing material, but just indicative of the competitive pressures that they face. And Matt Common did discuss the competition for what they call affluent borrowers and affluent customers. Macquarie, we know, is aggressively pushing into that space, and as are the other banks. And so I think, that combined with the fact that there wasn't really enough information for the market to upgrade their views on CBA, saw some profit taking at CBA, and in fact, all the big four banks and Macquarie as well had a difficult month.
It's a competitive market that they're operating in. And as we approach the end of the year, we're on the cusp of another annual review and outlook, the 2026 investment outlook from you, which we can expect over the next couple of weeks or so. Can you give us any insight as to how you're seeing things?
Yeah, I don't want to give away too much, but there'll be a bit of a discussion similar to last year about the AI bubble. I feel like it's still an ongoing discussion.
It's certainly top of the menu.
It's probably intensified a bit more this year, so we'll be chatting around that, our views of the different economies next year. I'd say we're probably cautiously optimistic going into the year. We think the tailwinds are still there. And growth looks like it's going to be okay. We're not predicting anything dire. And some of the things that we spoke about last year, the geopolitical environment, maybe have calmed down a little bit. So, I'd say probably the theme is sort of cautious optimism.
Yeah, excellent. Oh, well, I look forward to reading that over the next few weeks ahead. And obviously we'll sit down to talk about it as well for one last podcast before the year is done. Thank you, as always, Nick, and thank you to all our listeners.